Hello, and welcome to The End of the Chain. I'm your host, Samuel McCullough, and I want to welcome you to this episode where I am joined by Stani Kulechov, the CEO and founder of Aave. Aave has actually been in the news recently, the DeFi news, for being the enabler of the BZX exploit. And what this actually was that a hacker, a black hat hacker, used Aave's flash loans to, within one block, do a bunch of stuff, which is kind of difficult and complex to get into right now, but I should do a later podcast with Stani where he comes back and talks about it. We actually recorded this a few weeks back. Today is the 24th of February, and I recorded this a few weeks back, and unfortunately, we weren't able to cover any of this BX stuff, but we did cover a lot about the lending markets and about the growth of Aave and about some of the awesome features that Stani has been working on with his team. So I'm really excited to get this out there for you. If you like The End of the Chain, make sure to support us. Share the podcast, send us around. Actually, leave a donation. Help keep this podcast going. I really want to thank you guys. Our numbers are just exploding now. I am so excited by all the growth in this podcast. It just is so cool to see the organic growth. All right, let's wrap it up and hop into the episode. You know, the thing about Bitcoin is that it does one thing really well, right? It's good for speculative price appreciation and depreciation. But until it just didn't, I worked as a trader for a while, and prices going up and down is just not that interesting. Stock prices go up and down all the time. And it's not the most interesting thing to me. And so when the DeFi stuff came along, finally, I was able to look at it and see a real thing that people can use for everyday payments, or even big companies to use if they want to transfer. Because I watched in both 2017 and 18 as people would try to do selling even $1 million worth of Bitcoin can be a very tedious process, especially like OTC, right? Because there is no one average, right? So where do you get your price, right? Is it from Binance? Is it Bitfinex? Are you taking an average of them? And so first thing is just to determine the price, right? You could have spreads of like $200 to $300, and you have huge volatility on every day, where the price can move inside the hour where you're transferring it, $30 to $40. And so it just didn't make sense as a good payment. I mean,
as a medium of exchange, it really it's a bit painful when it fluctuates.
So there's this in Bitcoin. There's this theory, right? It's called the bubble theory of money, right? And so the Bitcoiners think that Bitcoin was created, it has a fixed supply. It's going to be extremely volatile, and it's just going to be in a perpetual bubble, and the price is just going to continue to go up and up and up and up and up. And at some point, something happens, and the volatility goes away, and what's left is, this is what I've pretty much heard from every single Bitcoiner, is that eventually when the price gets high enough, the volatility goes away and it just becomes a stable money. But I don't actually understand the steps that would need to be taken, even with all the derivative products they're getting added on. I just don't understand all the steps that would need to get taken to bring the volatility down to what the dollar is, right? Where you're looking at maybe a big move would be like 0.25% or 0.5% of the day. 1% move would be oh my God, into the world.
Yeah, and I think that's the thing, because when people look into DeFi, and for example, even DeFi-based stablecoins or over-collateral stablecoins, and I think that from the perspective of the Bitcoin community, it's pretty much that that might be a solution for a time, but then on the long run, it's the basically Bitcoin which will be the medium. And the thing is, if you compare it to the US dollar, I mean, the size of the economy that's basically backing it, it's enormous, and it's always basically compared to other traditional currencies and exchange. So the volumes are just the magnitude of the volumes are completely different, and uh, that's the thing. I mean, what it takes to for example Bitcoin to become kind of like a non-volatile medium of exchange payments currency. I mean, it's not just about limiting the supply to some extent. I mean, if you look at traditional currencies, there's monetary policies and there's many things involved there, and very long track record. So it's I've always I loved Bitcoin. I mean, I love the technology behind
I still do.
it.
I think it's great. I mean, I'm not anti-Bitcoin. My thing is that just when I look at what people want to use on a day-to-day, or even not like people and businesses, right? They want to transact in something where if I'm sending $100 million overseas, the person on the other side gets $100 million, or the exchange rate that they can. They may lose a couple of basis points in the exchange rate if they're sending money in that size. And that's not really possible with, I don't even think that's going to be possible with Bitcoin. So in my mind, the greatest achievement that we were able to do was to finally be able to create stable, like trustless, decentralized, stable tokens pegged to the dollar out of highly volatile currencies, which we have with DAI.
And it's actually interesting that you brought this up, those steps that you were talking about, because if you look at basically how the banknotes were created, let's say, for example, US dollars, they used to be basically gold backed. So you backed a promissory note, which is basically a let's say $1 bill.
Mm-hmm.
You basically back it with gold, and you store it in a place who basically then owns you the gold, and then you have the note that you can actually redeem that gold or any other collateral there, and then you basically trade that note with your peers if you don't want to move that physical. And that's basically kind of like what is happening now in the DeFi space, that we went through that step, and that step can even evolve, that basically the collateral becomes less volatile, or the currency is more trusted, that it might not need the full over collateralization, which basically happened in US dollar. But kind of like what Bitcoin, one of the perspectives towards Bitcoin is that basically we're not taking into account this particular big step. And this step actually helped now. I mean, in the similar way as in traditional finance, where you have the note, now you basically have a note that could be traded, and as it is actually traded, you can have different kinds of utilities, and also depends, of course, what's the value behind it, but you can always peg it to something, to some receivable. And I think the DeFi basically has this step now. It definitely it's nothing new. The pretty innovative part is that it's self-custody because of smart contracts and so forth. So that is like the cool part, like what we are doing now, and now we basically go through that step, and now we're in a step where those notes are basically used. So when people are depositing to Aave or to Compound to basically get some yield, they're utilizing those notes. I mean, the stable currency, and you can actually use it now because you basically can trust that the value remains the same because there's more value behind of that particular note. And in this case, it's a cryptographic token.
Exactly. So you can take all that volatility and you can live with it, because most people want to hang on. They want to hold their Bitcoin. They want to hold their Ethereum, and then they can take a loan, a dollar pegged loan, which then they can use in their everyday life, which I think is the huge kind of awakening. And this is why DeFi has just exploded, I think, in the past year, approaching $1 billion. It's the greatest innovation that we've had so far, is to be able to trustlessly like create dollars out of nothing.
That is true. And I'm still amazed. Like, I think it was 3 years ago when kind of the whole DeFi movement. I mean, there wasn't actually for DeFi. I mean, there was just a couple of protocols, and I remember us starting with the ETHLend protocol, which was just basically an experimentation. And this was the age before the stable coins. So that was a good example where we basically created non-custodial way of taking loans, over-collateralized loans. And because you didn't have a stable value there, what was basically challenging for the counterparties that you could borrow ETH, but you're subject to the ETH volatility. And then your use case is basically the very same trading and speculation. And what we had to do before the stablecoin era is that we actually let people to actually borrow Ethereum pegged to a USD value. So you could borrow 100 USD worth of Ethereum and you need to return 100 USD worth of Ethereum. But that requires always that the person that is lending out, he hedges himself somewhere in an exchange. So it was still a bit challenging. And those stable coins basically changed the space a lot. And then it became actually easy to create different kinds of financial products and on top of the this kind of infrastructure. And that is how we kind of evolve into this close to 1 billion. And I'm pretty sure we're popping that number pretty soon. I mean, it's very close now. And I hope we get more kind of like not go beyond the 1 billion mark just by increase of the ETH value, but also kind of like more users coming in and just getting excited to use these services.
Right. And I've just been surprised at the speed of new development that's happened. You know, I know, like, so what was it? Compound and Maker. So Maker was back in 2017 when they kind of kicked off, and Compound was 2018.
Yep.
But in 2019, it's just so many products came out. Fulcrum, or sorry, BZX, who was on here before, and their Fulcrum tokens.
Yep.
And just all these different protocols that allowed people to start creating new financial products that they could just put out there and see if anybody wanted to come along. Like token sets is amazing, that you can pre-build portfolios and sell that, or not even pre-build them, but have a socially built portfolio.
Oh, I love
that you can
social trading.
Yeah,
that's pretty cool.
Yeah, so you can have a socially built trading portfolio that you can sell to other people and collect a fee on it. And all of the custody and management of the portfolio is done trustlessly. It's very cool. I've just been amazed, right? But it really leaves me asking a lot of questions, right? So I guess two biggest questions. The first one that I've kind of been looking into is does the MakerDAO contract need to start integrating like real world assets into it to lower the volatility of the token itself and bring down the interest rates over time? And I'm mixed on this. I've been reading a lot about this.
Oh yeah.
Yeah. So I'd actually like to hear your opinion about this first.
Yeah. I mean, this is very, very, because there's so many, why the question is hard is that there's so many levels of ideology here, economics in different levels, and narrative as well. And basically, I mean, in theory, we always kind of feel that, for example, Ether is a way to kind of like, that it's not, there's this narrative that basically Ether used to be gas and now ETH is money, it's programmable money, and basically it has different kind of function, and it ensures the DeFi protocols and the whole blockchain and Ethereum blockchain and whatnot. And what is interesting that we kind of like feel in the Ethereum community very easily the kind of like understanding that ETH is decentralized money in some kind of like beautiful way. And the kind of challenging here is that we always kind of forget that there's actually no such thing as actual like trustless environment. I mean, we don't get me wrong, we are developing trustless smart contracts and executions that are trustless. But end of the day, someone is trading those assets somewhere, and they have their own supply and demand, and it's always based on how do you trust the economy and how do you trust the actual whatever you're basically benchmarking. And in terms of, for example, Ethereum, definitely you could say that it's a trustless currency in the Ethereum blockchain. I mean, you could use it; it has value and so forth. But you always basically are trusting the people behind of Ethereum, the growth of the community, and the future prospects of the whole particular blockchain. So basically, if Vitalik leaves the project for some particular reason to, let's say, Polkadot, and just abandons the ship, which I don't know, would not say will happen, but hypothetically, that affects the Ethereum benchmarking, the pricing, and so forth. And that basically shows actually that there is trust involved. So that's the kind of like theoretical example that actually all of these assets, whatever they are, whether it's ETH or whether it's something that has custody, like for example USDC, they have some value. Now, the next question is basically how much you can, what kind of value you want to have and how that value is controlled, because you might have a real world asset that is controlled by one custody, or is the solution that there is some broader concept of decentralization, for example, a DAO that controls a custody of different assets, and that value is then used in the smart contract transactional infrastructure. So I think what is the scariest part is that what people are actually scared is not the actual trust, because I believe that we can't avoid it. I mean, it comes from somewhere. Everything is subjective. But basically the level of trust. People probably don't want in the community that the decision-making and the governance will become like pipelines instead of like widespread decentralization. And I think that's the kind of like scary part, that we have real world assets and somehow the governance of those assets and the value derives outside, and it's controlled by not many but few, and we go back into the old system. And I think that's the question here.
Yeah, I think it's an extremely nuanced question. I think that the simple answer would just to be to leave like the Psi as Ethereum only, trustless money, right? And then DAI as they go forward will become actual multi-collateral, and to bring on outside assets into it. I think that's probably the long-term solution. But
Yeah.
at the same time, I'm kind of having this changing view that Ethereum, in a broad sense, is a liquidity aggregator.
Yeah.
And it separates itself from Bitcoin in that anyone can create a token for anything. And it, at first, right, we don't, everybody created ICO tokens and now we have money. And the next logical step is to kind of create these, NFT tokens that represent real world assets. And I think that's kind of the last stage where the laws come into place to allow companies to create on-chain physical or like digital representations of physical assets on-chain, which is kind of the last step of onboarding all of this liquidity onto Ethereum. Now, how that happens and the speed with which that happens, I don't know what that will be, right? It could be decades. But at the same time, one of the other things that gives me a lot of hope is that because the DeFi narrative is so strong with Ethereum, it may not ever take hold of something like Bitcoin, right? Where the scripting language is much simpler, and it prevents people from just experimenting to like what happens on Ethereum, right? So it may be the case that in the long term, you have DeFi protocols like yours and the other ones on Ethereum, which just gather so much liquidity that it just wouldn't make sense to have a lending protocol on EOS or on Bitcoin or on anything else, right? Because you could just easily bridge your tokens over into Ethereum, get one-to-one representations, and then enter the lending or DeFi market with that.
Yeah. And I think it's pretty much happening now. Sure, there's the WBTC is just one example, but I think what we'll see more is that kind of like a winner takes it all. And I will see it somehow, in a way that everything will exist, at least for some period of time, whenever there's open source technology and people are building from all directions. But I see it kind of like the similar format games where you have multiple formats, as we had, for example, with the I think it was the Blu-ray format and the I think there was the I can't remember the competitive ones, and which happens quite often in hardware side and
Oh, they have those giant CDs. Yeah, they're huge. I remember those. My neighbor had one of those, and they're like 3 times the size of a normal DVD.
And there was also like
Laserdisc.
Yeah, and VHS. I think there was like Betamax and all this kind of like format wars, and I think we see a bit similar. So once you get the market, because I think one of the interesting part of the network effects in the Ethereum DeFi space is definitely the liquidity. So where all the liquidity will be, it just starts to grow in a bigger vacuum and draws everything. And this is something we have probably never seen before, because everything is based on smart contracts, and you put algorithmic allocation of capital on top of that infrastructure. It basically means that funds are moving per block basis, and something that hasn't happened. Sure, big banks are trading with each other on a daily basis, but here you could actually vacuum all the capital, globally, and anyone can participate if we follow this permissionless narrative. And that's something new, because it can actually just basically grow to such a big extent. And it's very difficult for a new DeFi blockchain to basically compete with the Ethereum DeFi space and try to get traction. And I think those blockchain protocols that have raised even billions of dollars, they're not doing that much work. Where now it's pretty much looking very good for Ethereum in terms of the platform for DeFi. Of course, in the future you have as much as interoperability that you can connect these assets, but end of the day, the liquidity goes where it's most functional and most trusted, because it's not just about having quick block confirmations and as many transactions as you can have in one block. It's also the security itself. And you can't have security. You can't have scalability and in the sacrificing the security. So I think that the balance now is pretty okay in Ethereum, but of course the scaling is still the issue. But if you compare it to something like delegated proof of stake,
right? Speaking of like proof of stake and moving to proof of stake, will your guys' contracts be broken by the switch?
Well, I think one of the funniest thing, I think it was Vitalik who said that DeFi might break a bit the composability and with the ETH 2.0 and with the sharding. And later he posted a blog post about it, that it actually doesn't break it. But I think in one ways, we have a function called flash loans. So basically it means that a borrower can borrow 100% under collateralized liquidity for one Ethereum block. And the only condition for that transaction is that the user returns that loan in the same Ethereum transaction, which basically means that you could borrow in the same block and do multiple transactions. For example, you can open a trade in Kyber, close a trade in Uniswap, so you can arbitrage, or you can refinance a loan from DYDX to Compound and vice versa. So there's this kind of like atomic transactions that you could actually do. Now with sharding, if there will be this different DeFi protocols will be in different kind of like as hubs or shards. it will require more than one transaction. But if everything is planned in a way that DeFi sits in a one particular shard, and let's say we have another shard which is based not maybe on the DeFi, but some other kind of utilization of Ethereum, because DeFi is not the only thing running also in the
no, of course
so
not.
that way it really depends on how it will be architected, but from what I see, it will not break it.
Mm-hmm. And what's your kind of overall thoughts on it seems to be that maybe 2020 is going to be the year of NFTs, that it finally kicks off. I've seen some kind of rumblings about, a couple of digital artworks being sold, and there's a lot of games starting to pop up with NFTs. But I think there's a new service that I just saw called Rocket NFT, where you could borrow against your NFTs for a certain amount, up to $5,000.
This is the Alex project, and big shout out to him. I mean, it's a very interesting experiment.
Yeah. So, I mean, from running a lending protocol yourself, I mean, have you been thinking about NFT integration or how that would work, or
we have?
What that would look like?
I think we have been thinking NFTs since pretty much the era of CryptoKitties and those days. The thing with NFTs is I think people are a bit doing them somehow in the forceful way, because the idea of NFT is just to tag something, but we tend to try to bring that liquidity by tagging. And I think, let's say we have different kinds of loans. For example, each loan has its own peculiarities. So you want to basically, first you need to ask yourself, do you actually need an NFT? Because if the credit risk is similar, and if it's different, you might need different kinds of NFTs to tag those loans. And the thing is that we are trying to bring the liquidity straight to our particular loan or particular asset. Might be, for example, rare art. But to actually bring liquidity to NFTs, this is based on what I have been trying to solve, is that you need to package those NFTs into some particular category and then bring the liquidity. Maybe you have a basket of NFTs which are covered by shares of ERC20s, and those ERC20s could be traded at Uniswap, and since they have secondary market price, then those ERC20s could be used as a collateral in the Aave protocol to create their own lending pool, for example. And this is the way to provide the liquidity, because the liquidity is really the essence as to get more network effect, as I believe.
Yeah. I mean, maybe it's already there. I mean, you look at token sets and what they've done. I mean, you can definitely borrow against those because the value of the underlying asset. But but in less liquid NFTs, I think it'd be more difficult.
That's the thing. Basically, when you have a portfolio, for example, you might have a very, very rare painting of Picasso, for example. But maybe it's so rare that you can maybe sell it once a year, or you can benchmark the price every 10 years. But you might have a basket of, let's say, certain period of Picasso paintings with cubism and so forth. So kind of you can create a bigger basket and bring the liquidity, not maybe to the 100% of the value, of course, especially in rare art. But for example, even 20-30% of the value, which is then called loan to value ratio, how much you can borrow against, or how much you could trade of the underlying, because you don't need to trade the whole portfolio. I mean, you could trade partially. So that's the kind of thing I would love to see more of, this kind of ERC20, ERC71 combinations with baskets and bringing the liquidity into the NFT game.
Mm-hmm. Well, to really create a credit money system, which is what most of the world runs on, it's credit that makes the world go round. we're really going to have to solve the question of how do we provide under collateralized loans to
more than one
on
transaction,
blockchain, right?
more
So
than one
on
transaction.
Yeah, with more than one transaction. So you guys have solved it with your flash loans for one or less transactions, right? Or less than one transaction, so long as they can repay. But I think that's probably the holy grail of like finding a credit or establishing a credit money system on Ethereum is, can we figure out how to do under collateralized loans? And is that possible with that? Like, is it possible to do that trustlessly, or is it always going to need some outside reference to, like a third party rating system or some other thing which we already have today, which could be API'd in?
Yeah, this is something I've been thinking for the past 3 years. And the interesting part is always I have kind of made this conclusion that, the system, how the current credit-based system works, Wall Street specifically, is that everything is based on trust. And then we're now creating this DeFi, this magical wonderland where all transactions are trustless, and you don't need to trust anyone because of smart contracts and the collaterals and so forth. And now kind of like we're thinking, okay, well, how do we remove those? Not to remove, but how do we add those credit-based trust into the system? So I think there's this Ethereum smart contract systemic perspective that transactions can be trustless. People can send transfer value, but then there is also the underlying. So can the underlying be something that is based on trust? And I would say yes, because everything, all assets somehow has some sort of trust and belief and whatnot. And that I think that's I think the under-collateralized loans really is solvable. It just will be something that we need to accept in a way that we will have. Basically, bonds are a good example. If you tokenize bonds, you tokenize trust, and then it will be in the blockchain, and the itself transactions will be trustless, and you can govern those bonds in some decentralized way, and you might have underwriters or enforcers who enforce the loan. But I think we need to make a decision at some point, like, are we allowing this to be part of the kind of like a DeFi narrative? Or, in the same way we at some point decided, how the narrative went forward was that USDC is kind of part of the DeFi narrative. Sure, it's basically trust-based stablecoin. You trust that Coinbase has the value in their accounts and so forth, and their balance sheets, and that value is now used in the DeFi space, and it has some sort of DeFi narrative. Of course, it's not the same as, for example, DAI, which is backed by Ethereum and over collateralization. But basically, if USDC is possible, then even fractional version of that is possible. And there is one. USDT is, based on my understanding and what I have read in the past months, that it's fractional in the current moment. So there is less USDT to cover all the minted USDT tokens. So kind of like it already is in some way in place, and it's just a matter of time when there is a bank that actually comes into the space and says that, okay, we're issuing this amount of stable coins, and they're banked by our guarantee that if something happens, you can claim those proceeds from your losses from us. And that's basically the very simple form of debt. And then they price it based on defaults and so forth.
I think there's another way though, and I just thought of this actually, is if you in theory the loan needs to make sure that cash flows are coming in to pay the loan debt, right? So one of the things that I just thought about is that if you look at like RDI, right, where you can take the principal and interest and split them into two parts. Now you have a cash flow, and you also have the principal as well too. So you can borrow against the principal, but the cash flow would stay
and you can sell
with
the principal away. Then you basically have cash flow based.
Right.
Yeah, and I think that's a very very precise way to figure it out, because if you look at the current trust systems that we have, so money is basically created from thin air. So all the dollars, euros, rubles, whatever is the currency we have in our accounts, in our bank accounts, basically someone is paying interest on that. So when my dad walks into a bank and gets a credit assessment and a loan is granted to him, so basically when he gets that loan and starts paying that interest and buys, for example, a house, that other person who sells the house gets the principal, and he's the one who left paying that debt, basically. So he's paying the cash flow, and the principal itself is elsewhere, basically going back to the economy. So I would say that will be the one example way to do it. And I think that could be worth of trying, actually.
It's actually really interesting, though. You just have to figure out more cash flow producing assets, right? And I don't think that the interest rate of like 8% is not going to allow, like 8% interest rate is not going to allow you to leverage too much.
Can connect the principal, for example. In this sense, in this bank scenario, you basically are paying interest and principal back as well. So if you are able to get the principal as well, the amount will be higher. You can scale it even further. But I think you have a interesting case there to try out.
Yeah, or it would have to be. I mean, the only other thing that I can think of is that you have like community voted like banks, almost like a DAO bank, where the bank would have certain privileges of lending to people, or I don't even know. It seems too hard on the other side of trying to figure out who could be the entity that could lend under collateralized, right? But I think I don't know. I think we're there. I think we're like maybe in the next like year or two, somebody will figure out, or maybe the inclusion of real world assets will allow for this kind of structure to be built. Because there's you take like property, right? Just like we were talking about earlier. If you have a property token, so maybe the token itself can be traded around to accredited investors who have gone through a KYC process, but then there's all sorts of cool functions that you can do with the token, right? So you can split off the principal and interest. You can leverage if you want to do all sorts of fun stuff that gets done in finance every single day. You just have to have certain rules and regulations for that token. But that's fine. I mean, I think that's totally fine, and I think it's probably the next step that we have to get towards.
I think once we reach that 1 billion landmark and we are going further, I think more and more, even more professional people are. I mean, let's be honest, the DeFi space now has one of the brightest people here. I mean, there's no question about it. I mean, all the teams I have met and working different projects, and everyone are so busy and working. They're working in very cool stuff, and they're very smart, intelligent. And I see that I see myself in a very lucky position that I also have this kind of colleagues, and I'm surrounded by very smart individuals and very, very, very interesting collective. And it will be very interesting to see when the whole space scales and we get more people with economics backgrounds and trying to leverage all the products that people are building and all this composability, how it will end up. And it's interesting to see how the institutions will react, because at some point, I mean, you can't ignore it too much. I mean, if there's something happening in the space, there's yields, there's different kinds of products, you want somehow to get involved.
Right. So you can tell a bank, hey, this asset price has increased 100% in a month, and they won't really like bat an eye. But you tell them, oh, hey, you can get a 9% yield on your cash here, and you can do it, relatively easily without too much risk.
And what would be interesting to see, actually, I'm pretty sure like protocols like the Aave protocol Compound, they will pretty much be you have the collateral composition there, and you have pretty relatively there are high yields now, but I think they will settle a bit down and become more of a money market fixed income products in the future with less risk. And then you will have some DeFi products that are more they remind more of derivatives, and they might have this kind of like additional risk. So you have additional yields, and you have different layers of systemic risk and the economical liquidity risk associated. So you kind of have like an economy of different kinds of products there, and yields for everyone. There's yields for not just market risk, but in the kind of like traditional fixed income sense, that you have moderate risk and higher. And it will be interesting to see like how these different portfolios will evolve, and what kind of different entities will come. And hopefully, probably hedge funds will take a look into DeFi and Wall Street, and hopefully from 10 years from now, there will be pension funds. But there's so many questions to be solved. There's regulation, all the systemic risk and whatnot.
Yeah. Do you guys have fixed term?
Yes, exactly.
Lending, right? Okay. So in theory, I know they're building this at ETH Denver. It's a. Did you see this? It's called Row.
Yeah.
They're building a essentially a decentralized. It's almost like Uniswap for interest rate swaps. Exactly. Yeah. So I think, again, it's amazing how fast all of the financial infrastructure just gets ported over now that we have the ability to build all this. It's incredible.
Row is interesting because definitely I'm super excited on interest rate derivatives, and I think what's exciting about that project is that it really tries to kind of provide the ability to swap rates, but the kind of a challenge for them is to have the whole pool kind of have the model in a pooled way. So what is interesting in the relationship between ETHLend, our first project at Aave, and Compound, is that Compound basically improved the mechanics of the over-collateralized lending that ETHLend had, and basically pulled the model. And there's another project called Cherry Swaps that was built, I remember seeing it in Berlin. And they kind of
I saw that one.
Basically cracked the code to pool the funds by just limiting the kind of the upside and also the risk level that you can have from the interest rate, and kind of solve that thing. So it's just, this is the when people are talking about DeFi narrative, what's all about is basically that one project does innovation, another comes and builds on that and innovates further, and you will see this constant innovation. Of course, the limits for this, of course, is that we just need more developers in the space, and of course, there's always the diligence when we are building smart contract technology, that we always need to audit the smart contracts, and it takes time and be very diligent. But other than that, you see this constant innovation.
Mm-hmm. What do you think it is about the Ethereum, developer community that makes it so ripe for innovation?
I think in the very first place, I think the people that has been around from Ethereum in the first days, including Vitalik and so forth, I think they're themselves very kind of they are pushing very forward the kind of collaboration and open source technology, and I think that kind of aspect is something that has been in the whole space. I mean, we saw during the eco craze that there was all kinds of projects coming in, and they tried to commercialize and try to have proprietary technology and try to basically build value that wasn't the exact core Ethereum value and the community values, and they didn't succeed. And if you look at all the projects that are succeeding, mostly they have this kind of like embracing of the composability and embracing the open source technology, and that's the very key part. And people just understand the meaning of that network effect that it brings.
So looking back on it to 2017, because you guys launched in
we launched
December 2017,
first,
right?
Like the interesting part was that we had our main net. I think we had our testnet back in 2017 January. So we started to build in 2016. Mainnet was 2017 May, and basically we did our token generation event end of the same year. So we had a product, basically an MVP product out before our fundraising, but it was still like early days. I mean, 2016.
Yeah. I mean, my question really is looking back on it now in 2020, would you have made the same decisions again on the fundraise and also
I think
token generation?
I would say yes, because the thing is that my background is pretty interesting. So I used to do software development when I was in my teen years, and ended up deciding to go to law school instead. And basically, I wanted to know more about procedures and all this kind of contracts, and that was my thing back in the days. And I founded Ethereum in I think it was 2016 in the very beginning, and kind of like I was very inspired about the way to make transactions. Immutable transactions, and I'm basically from a small city in northern. In the Nordics, in Finland, in Helsinki. From Helsinki. And the thing is that the amount of capital, it's not the same from where I was compared to, for example, bigger places such as, for example, Silicon Valley or Singapore or New York and Berlin these days, and London. And what that token generation event basically allowed me to do is a college student from small Nordic town was able to basically just innovate innovate in the same level that any other human being in any part of the world, and actually provide the idea and basically get people behind your idea and back you in a very democratic way. So you kind of like democratize the finance. And sometimes I'm pretty scared about the fact that some Silicon Valley, there's its own advantage there and in bigger cities. And now Aave is in London and so forth, but it's a big city as well in terms of finance, but and VC funds. But I think always kind of feel that the democracy is somehow like evaporating, but also I see it coming back. There's now VCs that are taking these token positions, and they just want to be stakeholders in these protocols that they actually understand the network effect of the open source. So definitely, I would say it really democratized the way anyone could raise funds if you do it the right way and for the right reason.
Right. So were you a part of, did you know a lot of Ethereum developers back then, or did the raise actually help? This is essentially what you said. It helped you kind of connect you to a bunch of people who then came on interested into the product.
Yeah, I think the funny part was that I knew few, actually couple only Ethereum developers back in 2016. And one was actually my friend in Moscow, where I was actually doing my student exchange program. And we started to do small things with him, and I didn't really get that much. I was always kind of a bit on the side, but once we got more and more involved in the space and in the different events, then they kind of like I was more involved in the community. But in the beginning, it was definitely like I felt that I was a bit more distant from other Ethereum community people and so forth. So I would say that in the beginning I didn't feel that much of a connection, but end of the day, looking at now, I mean, it's a small community. Everyone knows each other and supports each other, and you can definitely see that in the DeFi space. We talk with different projects and try to basically brainstorm with different ideas, and I think that's the beauty of having like so small community.
Mm-hmm. Yeah, no, I mean, I've kind of jumped in headfirst in 2017, and I really have seen the growth, and I don't know. I mean, I've always been more preference and more interested in what's being built on Ethereum, just because it's the stuff you read about is just way more interesting than anything else that I've seen. I mean, I think it leads me into the second kind of question that I want to ask you. Come back from the first one that we talked about earlier, and this is one that I've really been kind of thinking about for a while, and it's, does the DeFi space, does the creation of this trustless money, does it actually break us away from this modern surveillance capitalism that we've created? So we have, Federal Reserve, we have big tech companies, and we have governments around the world who are designing monetary systems so that they can greater track their citizens, and they want to know every single transaction and where the money's going, and who's on the receiving end, to essentially build the biggest picture about their, I guess, monetary system that they can, right? And so it can be used for law enforcement, tax purposes, all these other things. But at the same time, the kind of basic idea as money, as this, I give you $1 and I've just, or I give you €1, right? Or I give you a 500 euro, right? I can give you a 500 euro and I can transfer a lot of value to you. Nobody knows about it. And we can conduct economic transactions without the watchful eye of the government above us telling, what kind of commerce we can and cannot engage in. So does the DeFi space actually break that? Or if it doesn't, what sort of advancements are needed to be able
I think
to do that?
That's very good question, because if you look at the like why we are creating this like trustless technology that is in some arguments kind of like blockchain has always its price. I mean, it's always cost more money to interact with the blockchain technology compared to MySQL or centralized database. And I think if you don't achieve this kind of like freedom from control of your financial life, your financial path, we basically are not utilizing this technology in its fullest. And that will be very sad, because we're creating this interesting, magnificent space, DeFi space, and we are just basically using it in the same way we have used previously. So I think to achieve that, there's so many things in between. First, of course, is that the Ethereum blockchain itself is public, so there needs to be privacy. And Aztec protocol is one interesting project that is working on it now, and with the CK DAI and so forth. But this kind of innovation in terms of privacy is important for us, but also the kind of like understanding and consensus from everyone in the space that we actually, if we want to achieve this, we want to aim for that goal. Because sometimes it feels that people see DeFi as Wall Street 2.0 and nothing else. But then again, I mean, if you do it in this pure Wall Street 2.0 way, you're just getting kind of like more expensive interaction, especially if you add boundaries and, for example, jurisdiction by jurisdiction, let's say liquidity pools or some other boundaries, KYC and what you can offer for the retailers and whatnot. It will be kind of sad, because the smart contract technology itself could solve a lot of these issues, the custody issues and bunch of other things. And if we just don't utilize it, then what actually will happen is that we have this cool technology. We basically vacuumed all that capital that we have around into space, but then we don't deliver what's actually belongs to the humanity, and that will be sad.
Mm-hmm. Yeah, I mean, people look at every transaction is recorded, and they see, you know, transparency and openness. But at the same time, I see it as just a great data source for any person that wants to come along and try to identify.
And it brings transparency, because then you see, then you see actual yields. I mean, when you're comparing this decentralized lending protocols to centralized, I mean, you're pretty much the decentralized ones. You can actually scan all the transactions from the blockchain, and in terms of the centralized, you actually are trusting what they're saying, and that's exactly what we are trying to get away from. Like that, we have a distributed ledger technology that is therefore actually verifying that the data is true, and that's why it's pretty good tool.
Has anybody built on Aave yet?
I think
secondary derivative products.
We have had few of basically hacks during the few hackathons. There was a couple of interesting ones in the San Francisco Blockchain Week hackathon, basically where people used there was this team that they were very excited about arbitrage, and they basically built a way to make easier arbitrage transactions and utilize the flash loans. And there was basically, I think it was 1.5 weeks ago, there was a group called Arbitrage DAO. So basically, they want to utilize flash loans to create arbitrage transactions without actually putting their own capital. And they basically made the first flash loans, and it was pretty cool to see happening on the main net. Other things that I know that is being built is basically refinancing. So refinancing loans from one protocol, from DYDX Compound, and then liquidation. So using also flash loans, not just refinance, but liquidate CDPs, liquidate other lending protocol loans. And that's like the cool part, because that basically every flash loan that happens occurs. There's basically yield for the depositors that are depositing into the Aave protocol. So that enables them yield extraction from other composability components in the DeFi. So if something happens between DYDX and Compound, or the MakerDAO vaults and Compound and so forth, basically those yields, if flash loans are used, basically they rise also to the Aave protocol. And that's like a very nice example of how to utilize composability for like the Aave protocol benefit and their depositors who are depositing, and also people who are building these tools for the whole ecosystem.
Mm-hmm. And so what are you guys working towards in 2020 to address? Like, what are some of the big problems?
First, now we're working on governance. So we want to ensure that the protocol that we have, the open source protocol, is governed, basically, that we have decentralized governance, and basically that the lend token that we have is used to govern the protocol. So we want to make sure that we give away our power to the community. And I think when you're building big things, I mean, not that big, but important things, which is basically finance, and that is very touches very many and very important parts of their lives. You have to have something that has least control in concentrations, and you want to decentralize that as much as possible. So basically, for the next month or so, 2 months, we are basically focusing on the governance, and of course, we're putting new improvements into the protocol. And currently, we're having additional rounds of security audits. So we want to have as secure protocol as possible, and also try to figure out how to get more network effect and how to draw more liquidity into the protocol. I mean, it has been only 4 weeks from the launch, and I think the market size of Aave is now. I'm looking at this Aave Watch site that one of the community members made. It's 8.5 million, so it's pretty cool for 4 weeks of mainnet.
That is pretty incredible. I'm looking at the Aave Watch as well too. I mean, it's so cool to see like day by day how the borrow and deposits have just skyrocketed. It's this growing chart.
Definitely, and we're trying to now encourage more developers to build on the flash loan feature. And I've been brainstorming with as many people as I can and try to participate in as many hackathons during this year, just to basically get more developers involved. Because what the flash loans are doing, in essence, also they allow you to borrow capital without putting yourself. So it's a nice kind of like a way to lower the threshold of creating DeFi products. Now we'll definitely be eager to see something cool happening in the next couple of months.
Yeah. No, I'm pretty excited about it, and it's been amazing to see your guys' growth over the past just couple of weeks now with
awesome.
Aave. Yeah, well, cool. Stani, is there anything else that you want to touch on?
No, I think
that we missed.
Pretty much covered everything that we wanted, probably.
Cool. So where can you're on Twitter, right?
Yeah. So the handle is Aave. You guys can follow, or if you like Discord, aave.com/Discord. In Telegram, it's basically Aavesom. It's kind of like awesome, but Aavesom. And I'm pretty active in everywhere where I can, and don't hesitate to reach me out directly. Definitely, if you want to talk something about DeFi or Aave, or you are interested in developing and hacking something, just reach me out, and we'll definitely love to talk.
Awesome. Well, Stani, thanks. And thanks everybody for tuning in to this episode with Stani. I want to thank you, Stani, for coming on. Guys, thank you so much. I think we are really starting to hit some good growth of the podcast. I've been watching the numbers recently, and it's just super exciting. So thank you for being supporters of this podcast. Remember, nothing on this podcast should be taken as financial advice. And I'm not a financial investment advisor or a lawyer or anything else. So if you do need professional support, find somebody that has a license. Find somebody that is out there dedicated to actually doing this sort of job and is regulated, because it is a dangerous industry that's filled with volatility and lots of people trying to scam you out of your money. All right, that's going to wrap it up for this week. I will see you in the next episode of Into the Chain. I'm Samuel McCullough.